Well, hi everyone, and welcome to the Economic Alliance of Greater Baltimore's quarterly webinar. Today we'll be covering a regional economic update and an investment roundup. First, my name is Patrick Dougherty, and I am the Market and Research Analyst at the Economic Alliance of Greater Baltimore, and I want to welcome everyone here today. With us today is Rick Kohr, the CEO and a founding member of Evergreen Advisors. Rick has over 25 years of experience in advising early-stage growth and middle-market companies on growth financing and executing exit strategies, including capital raises, mergers, and sales. Rick is actively involved in a number of regional tech companies and organizations, including many of the region's incubators and the Howard County Cyber Commission. I'm excited to welcome Rick to our quarterly webinar to share his experience and some of what he sees at work every day. Rick, I'm glad you could join us, and thank you for coming. Please feel free to jump in and clarify or provide some perspective at any time.
I'll give you a little bit of background on what I'm seeing on a day in, day out basis with the work that we do in the biotech area, and then in the larger, earlier stage technology climate as well. So thanks, Patrick.
Sure thing, Rick. And if anybody of the attendees have questions at any time, there's a chat box on the right-hand side of the screen. Feel free to type in your questions, and either Rick or I will answer them to the best of our ability. So with that, let's go ahead and jump right into it. First, the Greater Baltimore region is home to about 2.75 million people, making this the 20th largest region in the country and obviously one of the top 25 largest U.S. metropolitan areas. Neighboring Washington, D.C. is home to about 5.86 million people and ranks as the seventh largest in the country. The region, despite gaining about 5% growing 5% in terms of population over the last 10 years, is one of the slower growing metropolitan areas in the U.S. But as you can see, looking around Baltimore on that right-hand chart, it's pretty typical of some other older East Coast metros. New York, Boston, and Philadelphia are all ranked right around Baltimore. The region is also one of the most highly educated in the country. Greater Baltimore ranks 8th in terms of bachelor's degree attainment and number 4 in terms of graduate degree attainment. Nearby DC is number 1 in both measures, making the Baltimore-Washington corridor one of the best educated areas in the country and in the world. Regional unemployment is down a little bit from the last quarter, which is good news, and it reverses a trend that had shown up over the last 6 months or so. Looking back, August has always shown a little bit of a spike in the unemployment rate. So it's a good sign that we're seeing a decrease here in this month. This decrease is mostly due to, and into this a little bit more as we move on, but it's mostly due to cyclical sectors of the economy seeing some significant job growth, areas like construction, wholesale trade, and administrative services. Hopefully this is a sign of good things to continue, and it would be really great to get this annual November bump that we see over the last 3 years as people find holiday employment and seasonal employment moving forward. And just so you know, these numbers are unaffected by the recent federal government shutdown, unless some companies were looking really far ahead and put hiring on hold, with some real foresight. Our next webinar in January might show a little bit of a higher unemployment rate, maybe due to some of the effects of the shutdown, but today we're going to be talking about August numbers. And with the shutdown not starting until October 1st, they're totally unaffected. The region has shown positive employment growth over the last year and over the last decade. Same thing with the shutdown here. There's really no effect because these numbers are from before the shutdown was even considered a major possibility. Our next webinar might be a little bit different in that sense, but as you can see, there's been almost 2% growth in Greater Baltimore over the last year. Maybe not top 10, but still above the national average. So we've got that nearly 2% growth, that 1.76% growth in employment over the last year, but where are all of these jobs coming from? 5 of the region's 9 growing sectors in terms of employment are industries that tend to cycle with the economy, things like wholesale trade, construction, retail trade. We can take this to mean that the regional economy is doing well and people are optimistic. There's demand for retail, construction, and administrative services. Other growth sectors are high-wage, next economy sectors that provide sustainable long-term employment, things like financial activities and healthcare and social assistance. These are also some of the fastest growing sectors of the decade, which is a good sign for the region's future. We're building on a strong foundation. It's interesting to note that the federal government employment has decreased about 4.5% over the last year. So To realize this sort of overall job growth, it's got to be that we're growing in the private sector, and in fact we are. There's 2.5% private sector employment growth over the last year, which represents about 28,000 jobs, and 5.8% growth in the private sector over the last 10 years, which represents about 62,000 jobs. Three of the most concentrated industries in the region are high-wage, high-growth sectors. Also making the list are state and federal government employment, which is expected, and two sort of cyclical economy-dependent sectors. We focus a lot on professional, scientific, and technical services as an industry that acts as a good proxy for the overall economy. These are skilled, educated jobs that pay high wages and promote growth. Baltimore is one of the most concentrated regions from professional, scientific, and technical services employment, which suggests a regional economy positioned for sustained growth and productivity. Greater Baltimore is also one of the wealthiest metros in the country, both in terms of per capita income and median household income. The average family in the Baltimore region earns about $66,000 a year, which is fourth best in the country. The region has also exhibited nearly 40% growth in per capita income over the last 10 years. The foreclosure rate in this region is a little bit high at 5.5% when compared to other metropolitan areas, but it's below its peak from about a year ago. I expected to see a slightly elevated rate of foreclosure for a little bit of time due to a large shadow inventory built up from robo-signing and banks being told to put their foreclosure processes on hold for a little while, and the fact that Maryland's a judicial foreclosure state, so it takes 6 to 9 months for a court to say, yes, this home should be in foreclosure, and the bank can take it and sell it again. Both of these have contributed to a pretty big backlog of homes in foreclosure. Historically, this market sees a foreclosure rate that's more similar to Boston and DC than New York and Philadelphia, so I expect the foreclosure rate to drop once the market clears out its built-up inventory. Baltimore homes are, on average, about $263,000, which is the 10th highest price in the country. But when you look at the other top 10 metros, you can see that there's a huge difference between the top 7 and numbers 8 through 10. Baltimore is significantly less expensive than other nearby East Coast metros. DC, New York, and Boston all hover right around that $380,000 to $400,000 price. So this is a much less expensive region to live in. Home prices in Baltimore are rising, but maybe not as fast as some other areas of the country. But over the last year, they've grown about 3%, which is significantly faster than they had in the previous 2 years. You can see that from 2011 to 2013, there's been a little bit less than 7% growth in home prices. And a lot of that is made up from the 2012 to 2013 change. We also like to highlight some rankings where Maryland and Baltimore have shown pretty well. So some of the recent ones that I want to share with you is that Baltimore was ranked the number 4 top city for small business by NerdWallet, who highlighted the area's hassle-free licensing requirements. And Baltimore was one of only 3 East Coast metros to rank and was tops among the East Coast cities. So it's a good spot to be in, ranked right among all of the Texas metros right there. And second, the Martin Prosperity Institute put together a list of global cities that was based on talent, technology, tolerance, and quality of place. And among all the U.S. cities, Greater Baltimore ranked 10th and got a B+ in talent and an A- in tech. So for a relatively smaller metro, they showed very well. Some of the top headlines from the region, this was actually a sort of a difficult slide to make because there have been such great headlines and some really good news, and it was difficult to pick which ones that we should share. The ones that I settled on were an award to arts organizations like the Baltimore Symphony Orchestra and the Walters Art Museum. Not only are these groups contributing to culture and quality of life, but they also support about 11,000 jobs. So Maryland State Arts Council is going to grant nearly $13 million to these organizations and a couple others like them to help them grow and continue their mission of sharing culture. The 2013 Inc. 500 list, which is the fastest growing private companies in the U.S., includes 19 companies from Maryland and 7 from Greater Baltimore. Videology, who we'll talk about a lot when we talk about investment, was the highest ranked regional company on the list at 137. And we've got Maryland and Greater Baltimore have companies in industries from technology to government contracting to healthcare or energy. So it really spans the board. And finally, maybe to toot our own horn a little bit, EAGB and the biohealth innovation down in Montgomery County have announced a partnership with Johns Hopkins and Dream It Ventures to establish a healthcare IT accelerator right here in Baltimore. Our goal is to provide some help to the region's small and growing technology transfer companies or the health IT companies that are coming out of University of Maryland, Johns Hopkins, and elsewhere around the region. Help them grow, help them create a network, and help them build their lives and their companies here. So with that, we'll jump right into the investment roundup. And Rick, of course, at any time, feel free to jump in and clarify anything that I'm saying here.
Okay, thank you.
Sure. The Baltimore-Washington CSA, which is pictured here, the combined statistical area, is home to over 9 million people. Sources for investment data tend not to distinguish between these two metropolitan areas, and it turns out that some of the residents don't really distinguish between them either. Commuting patterns show a pretty fluid movement of labor across the entire corridor. There are actually, and this is my favorite stat to share, there are 22,000 people that commute from Virginia to Greater Baltimore every day. So there really is a sharing of the workforce between these two metros. When we talk about investment trends, we'll be looking at the flow of capital within this region, asking questions like, does Baltimore win more of the corridor's investment than DC or Virginia in particular industries? This map gives a sense of where Greater Baltimore stacks up nationally and maybe who we're really competing against in terms of acquiring venture capital. This is all based on 2012 data, and the names shown are 2012's top 10 metros for venture capital acquisition. You'll see the usual suspects like San Francisco, San Jose, New York, and Boston on there. Baltimore placed in the top 28 and is actually right here. Baltimore grabbed more than $100 million in venture capital investment in 2012 alone. So this region is a serious player and gets some serious money, even if it's not one of the big boys in the top 10. Baltimore was ranked right around Portland, Salt Lake City, Houston, Dallas, and Cleveland in those 20 to 28 metros that weren't quite big enough to break into the top 20, but still earned over $100 million in venture capital investment. When you put DC and Baltimore together, and you can because of their proximity and that sharing of the workforce, you find that the corridor does a pretty good job of acquiring investment. Companies located in Greater Baltimore have raised $1.27 billion over the last 12 months. And that's not just venture capital, that's through the exempt offering of securities, which includes venture capital and angel investment and a couple other forms. Maryland has captured about 60% of the region's venture capital investment since the beginning of 2012. But that money is spread out over just 36% of the region's deals. That means that Maryland has seen some pretty large venture capital investment over the last 6 quarters. This is a graph of the capital raises by industry as a percent of all capital. As you can see, life sciences and technology earn about the same amount. Each of them captured about $180 million of capital. And the percentages are a little bit skewed by a handful of huge offerings from real estate groups, holding companies, and actually McCormick and Company. But life sciences and technology make up a majority of exempt securities offerings here in Greater Baltimore. Maryland captured an above average share of software venture capital coming into the region. Usually, as you can see, there's about 29–30% of the capital in software in the region headed right to Maryland. But in the last 6 quarters, we've captured about 43% since the beginning of 2012. And that's on the same share of deals as always, which is about 30% of deals. So the deals, you could say, in Maryland are getting a little bit bigger, which is part of a national trend in software investment, really. Software was the most invested in industry in Q3 of the US, which was the data for was not available for this presentation. But in Q3, software investment topped $3 billion nationally for the first time ever. Maryland captures a majority of the corridor's networking and equipment venture funds also. And as you can see, we've captured all of it over the last 6 quarters. Usually, this is an industry that sees relatively few venture capital deals, but some larger money. From 2007 to 2011, for example, that $160 million was spread out over just 16 deals. The share of venture investment in Maryland IT services companies has grown significantly over time. all the way back to 1997 to 2001, the region was grabbing just 26%, and then 27%, and then 41%, and now just up over 53% of DC and Maryland's venture capital is being funneled into Maryland. Only 16% of IT services deals have gone to Maryland companies, though, so there must be some pretty big deals. Well, there's actually one huge one that's really skewed the percentage of the dollars that have come into Maryland, and that's Videology, who raised $60 million in the second quarter of 2013. Based on historical trends, Maryland will see more IT services deals in the next few quarters and few years, but the percent of a total dollar amount coming into Maryland will probably decrease a little bit as deals of regular sizes happen. Unfortunately, $60 million deals just don't come into Maryland every day, as much as we would like them to. Companies in the region's incubators have captured at least $43.6 million in the last 12 months. $43 million is a pretty significant figure for small companies, both in terms of sales and team size, that are usually pretty young still, and maybe even are producing products that are in beta. And I say at least 43.6 million because not every incubator was able to share their data with me. Some of it has still been marked as private, not announced, whatever it is. So some investments aren't showing up in here. So I can very confidently say that the region's incubators have helped their clients secure almost $44 million at the baseline. Maryland companies have earned just under $500 million in venture capital investment, really $460 million in the last 6 quarters. That nearly matches total investment in Maryland biotech companies over the previous 4 years, which was about $550 million. A lot of that total is located in the Montgomery County to Baltimore City corridor, where there's a real strong swath of biohealth companies, but Greater Baltimore has had 2 companies raise significant funds. One is Glicknick, who raised $12.5 million over the last year and has recently entered into a licensing agreement with Pfizer, and Kohr, who raised $6.8 million over the last year and plans to complete a new technology transfer deal. Maryland generally receives a majority of Baltimore, Washington's venture capital funds in terms of medical device investment, and that trend continues since the beginning of 2012, when we've captured about 88% of the corridor's medical device venture capital. Maryland also tends to see a more consistent deal flow than Virginia or DC in medical devices, and has recorded at least 1 deal in every quarter since 2008 quarter 3, except for 2012 quarter 4. So that's 15 to 20 consecutive quarters in which Maryland has recorded at least 1 deal in medical devices. From 2007 to 2011, Maryland companies were responsible for over 82% of venture investment in healthcare companies in the Baltimore-Washington corridor. It's pretty surprising then for a region that's really a leader in healthcare, both in Maryland and Baltimore-Washington as a whole, not to see any venture investment through 6 quarters. But health insurance and other healthcare services companies have raised funding through other forms of investment, like the exempt offering of securities. For instance, Riverside Health raised $5 million in 2012 quarter 4 through 2 separate securities offerings. And this 4-year block is still pretty young, so hopefully we'll see venture capital coming into healthcare over the next year or 2. Compared nationally, the Baltimore-Washington corridor captures relatively few semiconductor manufacturing venture capital dollars. While the region sees some investment in electronics and instrumentation and computers, the 2 industries together make up about 3.5% of the total funds invested in Baltimore-Washington, which is a relatively small amount. But of course, those funds are very important for the companies here that do win them and do earn them. The $5.1 million in semiconductors went all to Pixelogen, who is a manufacturer of nanocrystal additives. Their nanotechnology will end up in electronics, plastics, and other products, and someday you might be watching an EAGB webinar on an HD laptop that wouldn't be possible without this company and this investment right here. Only 15% of all venture funds has gone to other industries. And when I say other industries, I mean things like media and entertainment, energy, consumer products, and retail. This is particularly pronounced in Maryland, where industries that we haven't really talked about, the non-tech and non-life sciences industries, total just about 3% of all venture capital investment. This isn't particularly surprising, given Maryland and the corridor's overall strength in technology and biohealth, particularly in the innovation and creation of startups in these industries. Interestingly, DC tends to dominate this other industry sector and has done so on the strength of a handful of deals in media and energy sectors. And finally, we get to take a look at something that is pretty unique to Maryland, and that's the state's venture investment fund. The Maryland Venture Fund over the last 4 quarters has invested $7.9 million in Maryland companies, 1/3 of which has been invested in Greater Baltimore companies. And $1.5 million is set aside for follow-on investment in those Greater Baltimore companies. Direct investment by the Maryland Venture Fund has contributed to the creation of over 500 new and 400 retained jobs statewide, so it's pretty high impact investing. The Maryland Venture Fund also supports the Invest Maryland Challenge, which awarded 3 $100,000 grants to firms in life sciences, technology, and general business. The life sciences and tech winners just happen to be Greater Baltimore companies as well. And this year they're adding a cybersecurity category, so there will be a 4th $100,000 prize out there. And with that, we're going to move on to questions and discussion with Rick. So Rick, I hate to start you off with a hard one, but does this region really have enough venture capital investment available to support the number of growing businesses located here? There tends to be a perception that there's just not enough capital, and is that a product of a comparison to Silicon Valley, who really has just a lot of money flowing around?
Well, I think it's that may be part perception, just trying to compare Baltimore, Maryland, the region to other parts of the country. Clearly, there are much bigger pockets of funding out on the West Coast, up in Boston, and some other areas that you've already touched on. But I do think when you're actually on the ground in this region, early stage companies looking for capital, there clearly is a dearth of capital available to these companies. We've probably worked with 3 dozen companies in the early stage area across industries over the last 5 years inside of Evergreen, and then with my angel fund, Chesapeake Emerging Opportunities, looked at literally probably 1,000 business plans over the better part of 8 or 9 years, and we ultimately looked and invested in 11 of those companies. And it's always been a daunting task for these early stage companies to find the funding needed to move their businesses to the next level. I think many of you have already heard of the donut hole in the funding scenario. This is, I think, very much focused in the area between friends and family round, the friends, family, and fools round, to the Series A, Series B, where a company just doesn't get on the radar screen of the venture community. The venture community is going through its own tumultuous times now. A lot of funds have gone out of business, aren't raising another fund. So the venture community has been a little bit more jaundiced about the types of companies they'll invest in, having revenues of 5 million or more, profitability, certain benchmarks are just difficult for a company to reach without some funding. And then that donut hole, as I said a moment ago, between the friends and family and where the venture is reaching out to companies is pretty significant. I think in the past that's been filled by these early stage venture funds and more angel funding, which does seem to be making a comeback relative to the economic times we saw in 2008 through 2011. But to answer your question, I think we really do lack venture capital in the region. Trying to get people into the area from other parts of the country to look at opportunities is certainly happening, but it's still a geographic gap there where people would rather look at opportunities that are close proximity to them where they can have a more meaningful impact. I can think of at least one firm that the Maryland Venture Fund is reaching out to try to bring them into the area on the cyber side and be focused in that area from a venture standpoint, and actually have a footprint of a venture capital fund here. And they're trying to ascertain whether there's enough activity to warrant putting a footprint here, knowing that the Maryland Venture Fund would put some monies into their venture capital fund. So I think you need to be creative. It's there's not enough capital, and sometimes that can be a good thing. Some companies shouldn't be funded at the end of the day, but it's clearly an area that needs attention. To Maryland's credit, done some really impressive things with the Investment Maryland $84 million being pulled together last year and being invested in the region. The bio tax credit, the cyber tax credit that's forthcoming. So trying to cultivate that, I think, is important. And fortunately, to the state's credit, we certainly beat them over the head at times about their business friendliness and the tax system, et cetera. But you got to give the state credit for what they've done with trying to cultivate the capital environment here in the region, because it really needs to continue to improve for us to continue to cultivate the kind of companies that we're working on in the region.
Right. Well, Rick, I want to ask specifically about the capital needs for a bioscience company or a pharmaceutical company versus a tech or a cybersecurity group. Our last webinar, we hosted Carl Gumto, and he made a pretty big point to say that there's enough capital here where, there really kind of could be for tech companies because they just don't have the capital needs that someone in biohealth would. So do you see, a real lack of funds in biohealth, whereas tech might be funded the way it needs to be?
Yeah, I would tend to agree with Carl in terms of the capital efficiency in the cyber side. Not typically the case in many areas of the biotech life sciences area. I think it's gotten more efficient in certain verticals within the medical biotech community in that regard, but it's still a long, daunting process when you're in the medical space, the biotech space in particular. Trying to find the financing for those companies, I think, is incredibly difficult. And that's in spite of the fact that first-time financings are up 11% this year. I think there's been about 346 companies that have raised money in the last quarter alone, but that's a nationwide statistic. But still tending to see a lot more money go into the technology side versus the biotech side. Now, I will say that depending on where you put mobile health and some of the other healthcare software efforts that are going on in the region and in the country, those companies do tend to see, I think, a more robust market from a financing standpoint. But the technology, the companies, medical device, therapeutics, diagnostics, that in this region in particular is a very difficult area to find financing, and literally have to go outside the region to find those dollars.
Mm-hmm. You acknowledge the long time frame that it takes to realize a return on investment in a life sciences company, just the amount of time, the amount of money that it takes to really get off the ground. How does that affect yours and other investors' decision to whether or not to invest in that industry?
Well, I think that's a great question. This is a little bit more anecdotal, but our angel fund, as I mentioned earlier, we invested in 11 companies, and we did 4 in the biotech area out of those 11. And we've had 7 exits to date, and 6 of those are outside the biotech area. The others have been modest degrees of success. One was sold out of bankruptcy. So we'll get our capital back here before the end of the year. But, these were companies that were invested back in 03, 04, 05, and still waiting to see an exit from those different investments. There are exceptions to the rule. A great illustration might be Martech that was located in Columbia, Maryland. That company took 20 years to build. But ultimately, when it sold a year and a half, I guess maybe 2.5 years ago now, to Royal DSM, a $1.1 billion exit, company Martech had already gone public. That was a wild success, but that was a 20-year story in the making. So I think, looking at your investment options, if you look at the various opportunities that come across the plate as an investor, you're going to tend to look at companies that you think can get there quicker, better, faster. And that time frame to a successful exit is important because that impacts your internal rate of return, your IRR. And I think, the people in this country, just by their very nature, they're impatient, and there's lots of ups and downs. And I think that that definitely has an impact on interest level in the medical space. And then obviously there's a lot of things going on that probably dampen enthusiasm on some investors' parts. The Obamacare with the medical device sales, the tax that's being applied, whether that sticks or not, I don't know. But a lot of shifts in the marketplace on the medical side as well, and that certainly doesn't help the dynamics.
Sure. So you mentioned Martech's big sale, and we talked a little bit about Videology's recent $60 million venture deal. Do those kind of big deals help draw attention and more money to companies that are in the area? Do investors say, what else is hiding in this place?
I think they do. I don't think there's any doubt about it. I think really from two different angles. One is, and we were out with the Economic Alliance 2 years ago in the West Coast, and one of the venture funds that we met with said they just don't look at Maryland as a hotbed for activity in the biotech space. They'll tend to focus their energy in Philly or Boston or the West Coast, San Diego, rather than Baltimore. So that that's, I think, part of the opportunity there is to see some of these wins, to gain notoriety throughout the country. SourceFire might be a good example here locally with their sale here more recently. I could tell you, and I can't mention the company unfortunately, but very large company looking to make a very significant presence here in Howard County area. Partly because of what's going on with cyber, NSA, but also because of SourceFire and looking to plant a flag here. And that could be a very meaningful, have a very meaningful impact on our economy. So I think it absolutely does matter. Call it PR, call it branding. But I think the other thing that spills out of those types of transactions, if we're fortunate, those people stick around. And that means their capital, their intellectual capabilities, the ability to start up new companies when these companies are sold is a real life example of what can be very impactful in the community. I know on the Martech side, there's a number of key people that have left there after the acquisition by Royal DSM and splintered off into companies that they're working on, that they're starting, that they're funding. We just helped a couple of the ex-executives at Martech create a company in the brain health space and nurture that along and raised about $2.6 million in capital to allow that company to expand. And, if those people, their capital, their ideas leave the region, then it really has no impact. If they hang around when a transaction like that occurs, it creates more growth in the region just by the very nature of their intellectual capabilities and their strengths. So I think, it's really two positives from that standpoint. It's both the branding, but it's also the people and the capital that stays in the region.
I agree that reinvestment is so important when we're talking about building and maintaining an ecosystem. And I know Videology does represent a reinvestment already by an entrepreneur who has just done really fantastic things in the region. So it's good to have those people around, and it's good to have them sharing their time, money, expertise, whatever it takes to help other people grow. You mentioned the proximity. Sorry, go ahead.
I was going to say, that's a spin out of, advertising.com and, those types of transactions, having companies like Millennial Media in the region that are growing like they are, making a real impact in the mobile marketing area and going public. They're all critical to the success of the region. Under Armour, that's they're priceless if you can keep help them grow, keep them in the community, and watch the talent that leaves those companies, which invariably happens. It's critical. Matter of fact, real life example with Under Armour, one of the key folks there, Bill Krause, left Under Armour. He was head of their marketing right up through the IPO, and thereafter left a couple years ago. Had a passion, and he's morphed that into Mission Barbecue with a partner of his that built this company that had an idea, bringing, lack of a better way to put it, world-class barbecue in a casual, semi-fast food setting. And I think they're up to 4 locations now here in the region and expanding throughout the East Coast with their concept. And that was just a talented person that created some net worth out of his experiences at Under Armour and took his marketing into a totally different sector that's having a nice impact in the region and more broadly.
Definitely, and serving some pretty good food, if I if I can say that. Rick, you mentioned the proximity to the NSA and the federal government being a pretty big draw for areas like Howard County, for example, was one that you named. Even though we haven't looked at federal grants or loans to companies in the region, we know that proximity is important. But how important are those federal dollars to startups and early stage companies in the cyber and life sciences arenas?
I think it's incredibly impactful. It's a way to fill some of that gap in the funding that we just talked about, that donut hole. It's a way to garner dollars to port into our research and development, port into intellectual property where you can't, go out and sell the product today because it's not ready for the market or hasn't passed FDA approval, 510K or whatever it is. Just left a company yesterday that's down at the Maryland Biopark at a board meeting, and looking at their pipeline for the tail end of 2013, 2014, and probably a third of their pipeline are grants that they're actively pursuing, government initiatives that they want to push forward in certain areas that this company has a really good opportunity to garner some of those dollars. So it's very very important. They wouldn't be able to pursue these initiatives without those dollars. May not even be in business without those dollars. And obviously, too, those dollars are important because they're part of the University of Maryland medical system because they're literally contiguous to that facility. They're hiring people. They're moving things and ideas along. And without those dollars, those things just don't get accomplished. So I think it's incredibly important.
Is there a danger that those dollars, though, end up making some people in the region a little bit more risk averse, where they say, I'll chase the grants and loans from the government rather than seeking out investment capital?
I guess that's plausible. I can't think of many situations or companies that we've worked with that, become so reliant, or maybe they do become reliant on the federal dollars, but they're so myopic that they would look at that as the only source of funding for their potential idea or service, their product, whatever it is that they're working on. I think it's prudent to look at that clearly as part of a growth strategy, but to focus strictly on that or solely on that particular type of funding is clearly a mistake, because as we know, the government has ebbs and flows in terms of initiatives, funding. God knows what else is going on down in DC, but I can't say I've worked with many companies or any companies that have looked at that solely as their source of funding and revenue and whatnot. It clearly would not be prudent from a business perspective, I don't think.
You were very complimentary before of state programs like the Maryland Venture Fund and Invest Maryland and all the capital that they've been able to raise. How has that changed the landscape of investment in the greater Baltimore and Maryland region?
Well, I think it's a little early to tell. The programs, funded last year, the venture funds that are being funded as part of that initiative through the Maryland Venture Fund, some of which they'll be managing. A big chunk will be going into these out of the region venture funds for the most part, although GrowTech, I think one would argue, is still very much a local presence here, albeit a lot of their main people right now are down in Northern Virginia. They do have an office in Hunt Valley as well, but I think it's a little too early to tell, but it would be very disappointing to me that this doesn't have a meaningful impact on the region. And it's $84 million. It's being invested over a litany of different companies in the region. The venture funds that are bringing a presence here, and they're actually, as I said earlier, a push to bring in a cyber-focused venture fund. Don't know where that stands. I know there's another venture fund that's being actively pursued in the biotech space. My sense is there's an announcement forthcoming here on that. So you're bringing in funds that not only are going to be grabbing money from this $84 million pool, but bringing in their own dollars. And that's critically important in helping the capital and the ecosystem here in the region. Our angel fund, as small as it was, as I mentioned earlier, we invested in 11 companies, and I lost track at some point or another around subsequent rounds. But I think we partnered with 31 other funding sources to get these 11 companies the funding they needed to get out of the ground. So having those funds in, having those monies deployed on top of TEDCO and Able Foundation and all the other various angel funds that are in the region, Blue Ventures, Baltimore Rangers, etc. I think is critically important, and I'd be very surprised if it doesn't have a meaningful impact in the community. I still think it's a lot less than what we would like to see in the region, given what the opportunities are. But again, too much capital can be a negative thing as well.
Sure. So maybe to change gears a little bit, can you leave us with an idea of some of the differences in things that you look for when determining whether you want to invest in a life sciences firm versus a cybersecurity firm?
Well, I think, one of the things my partner in the angel fund, Steve Dubin, I'll give him credit for this comment early on in our process, is we always look for an A management team and a B business plan versus an A business plan and a B management team. So, critically first, it's got to be a good concept. It's got to be a good opportunity. You got to be able to wrap your head around what's attempting to be accomplished. How big is the market? But you really need a great management team, because it doesn't matter what's on a piece of paper. The plan's going to change. You're going to head down the highway and the road signs are going to tell you one thing, and the weather's going to change. You got to be able to move and change direction, and that's really where the management team is so critical. So, from my perspective, it's management team first. On the bio side, really, I think looking at what are the risk factors, the boxes that have been checked at this point, and working with the company right now in the medical device space and talking to a number of early stage VCs, unfortunately all out of the region. And they're looking for boxes checks. They're looking for the management team, but they're looking for FDA approval. They're looking for CPR codes already being issued so that you know how you're going to be reimbursed. They're looking for a CE mark to sell overseas. They're looking for channels of distribution. So I think if you're going to be in the medical biotech space looking to raise money, and obviously it takes money to get to some of those things I just mentioned, but they're the things that I think we're looking at from an investment perspective, is having as many of those boxes checked as possible to look at an opportunity there versus potentially some other industries, because it's a long process to work through, to get to 510K, to get through phase 3 trials, depending on the type of product that you're trying to develop. It takes a lot of money, depending on the vertical that you're pursuing, less potentially in the medical device than in a therapeutic diagnostic. And you got to make sure that you've got the dry powder to back up subsequent rounds of funding. So they're the things that we really look for if we're going to do something in the medical biotech space, that we look for to try to distinguish between an investment in that opportunity versus something else in the marketplace.
Well, it makes sense. Thank you for sharing a little bit of the insight that you have on both bio and cybersecurity. If nobody else has any questions for either myself or Rick, then that will conclude our quarterly webinar. I want to thank everyone for joining us. Here's my contact information if you have any questions about any of the things that we've talked about today. I'd like to share some of the links to the publications that we've been discussing. The industry profiles are available on our website. It's key fact sheets, one-page sheets about 11 key industries in the greater Baltimore region. Also included there are the quarterly economic update and the new investment roundup. So with that, Rick, I want to say thank you again. You've been a fantastic guest, and I really appreciate you joining us today.
Well, I appreciate the time and everybody listening, and if there's anything we can do to help, please feel free to reach out to us.
Great. Well, have a great day, everybody. I'll be following up with an email, including all of the links to our publications, and this webinar will be going on YouTube if you'd like to share it with anybody. So thank you. Take care.
Thanks.